rose only marginally, 3.6% from 3.4% in April 2013, while core inflation declined to 5.6% from 5.8% over the same period. The monthly headline and core inflation rates also decelerated to 0.1% and not from 1.4% and 0.2% respectively in May 2013, an indication that inflationary pressures have remained muted. The forecast of the Bank of Uganda for core inflation over the next 12 months has improved in two respects. We are now forecasting slightly lower inflation rates in the short term. In addition, there has been a reduction in upside risks that average inflation will be higher than the medium-term target of 5% over the course of the next 12 months. The change in the inflation forecast is mainly for two reasons. First, household consumption demand is weaker than previously estimated, which is likely to dampen demand-side pressures on consumer prices. Secondly, the exchange rate has appreciated more than previously forecasted, which dampens the pressures on the prices of imported consumer goods. The Bank of Uganda forecasts that core inflation will stabilize around its medium-term target of 5% over the next 12 months, with the balance of risks being roughly neutral. Economic growth in 2013 is now projected to be higher than the previous fiscal year. Nonetheless, the recovery in output in this fiscal year is driven by net export demand, and to a lesser extent, investment demand. In 2013-14, it's unlikely that net export demand will continue to provide the primary source of growth for the economy, and consequently, domestic demand will have to make a larger contribution to the growth of output. Although we expect that there will be further growth in investment, both from the public and private sectors, a rebound in household consumption spending will be necessary to boost aggregate demand and real economic growth in the next fiscal year. Although growth in monetary aggregates continues to pick up, private sector credit remains constrained by both the high banking lending rates and structural factors. Strong credit growth will be important in boosting demand next year. Given the improvement in the inflation forecast and the need to stimulate domestic demand to support the economy in the year 2013-2014, the Bank of Uganda will reduce the central bank rate by 1 percentage point to 11%. This should also be a signal for commercial banks to reduce their lending rates further in order to boost demand for credit. The band on the CBR will be maintained at plus and or minus 2 percentage points on the CBR, and the margin on the discount rate will be maintained at 3 percentage points on the CBR. Consequently, the rediscount rate and the bank rate have been set at 14% and 15% respectively, beginning today. I thank you.
Thank you.